The Finance Bill 2023 was passed in the Parliament on the 24th of March, and it comes to effect from 1st of April 2023 onwards. So there are four key aspects in the Finance Bill 2023 that has an impact for all investors, and that's what we're going to cover today. What are those four things that have a big impact on our money in the forthcoming financial year starting from 1st of April? The first one and the big one was that there was an amendment made to investments done in debt funds, gold, international, and funds in which equities are less than 35%. And these are what I'm referring to as non-equity mutual funds, or funds in which equity component is less than 35%. In all these categories of funds, the finance minister has made it that any gain that is made, irrespective of the holding period, will be considered as short-term in nature. What this therefore means that any gains made on these investments, be it a debt fund, be it a gold fund, be it an international fund, or a fund in which there is less than 35% equity holdings, will be considered as short term, and the gains that is made will be added to the total income of the person and taxed at whatever rate that that person is taxed at. So this is a big jump. Why is this big? Because till date, investors who invested in any of these categories of funds were getting a big benefit as long as they held the securities for more than 3 years. If you held your investment for more than 3 years, these were considered as long-term capital gain, and because they were considered as long-term capital gain, they got the advantage of indexation, because of which their tax efficiency was very high as compared to investments in bank fixed deposits and many of the other things. With this current amendment, the difference between a debt fund and a bank fixed deposit has been effectively removed from a taxation standpoint. So from 1st of April, debt funds will have to prove themselves to be better performers if they have to collect money rather than look at tax efficiency as an opportunity. That's a big difference, a big blow to the debt mutual fund industry as a whole. But I think change is the only constant, and the industry, I am sure, will now focus on debt fund performance and how that performance can generate the alpha and bring investors to debt mutual funds rather than to use taxation as the means of attracting investors. So I think the game is clearly open to the mutual fund houses that they need to up their game and prove that on a performance basis they will still be able to beat the bank deposits. And so this provision is very positive for the banks. This will enable more fund flow to the banking industry, which will enable capital formation on a lot of things, but not so good for the mutual fund industries, at least in the short to medium term. This will apply only for investments made after 1st of April. So whatever investments are done prior to 1st April 2023 will continue to get the benefit of all the taxes, including long-term capital gains and indexation benefits as before. Coming to the next provision, this relates to life insurance industry. Life insurance premiums which are above rupees 5 lakhs per annum paid for non-ULIP insurances will hereinafter, after the 1st of April, maturity proceeds of these insurance policies will be taxable in the hands of the recipient. This is a significant move. So if you took a life insurance policy, a non-ULIP life insurance policy after the 1st of April 2023, and you paid an insurance premium higher than 5 lakhs, then the maturity proceeds of that would be taxable to you whenever that happens. Now this is pretty significant because so far the insurance receipts were largely tax-free. Especially the non-ULIP insurance proceeds were largely tax-free, because of which a large amount of high net worth individuals were using this as a very conscious tax planning route. Irrespective of very low rates of interest, they continued to make their investments into these products primarily because they wanted a tax shelter. With this provision, effectively a large portion of all that transactions have been rendered useless, and proceeds, if they are made above 5 lakhs, will hereinafter be taxed. Now, as far as ULIP oriented policy, the provisions were already there that if a ULIP policy's premium is more than 10% of the sum assured in any given year, then the proceeds is already taxable. Or if the premium in any given year is about 2,50,000, then again the maturity proceeds of these policies are already taxable. So ULIPs was already covered earlier. Now with this regulation, the non-ULIP or the traditional life insurance plans, as they were called, have also been kind of brought under the ambit. This is a big negative for the mutual fund industry, which used to collect a substantial amount of high net worth individuals' money into these kind of products. And these are long-term monies that these insurance companies gathered, and they would stay with them for 10 years, 15 years, 20 years. And really this is a bit of a negative. The positive being is that now all this money will have to come in either to the banking sector or will have to come into the mutual fund or bond sector. So that way you will see a reorganization of money flow happening. Again, in this case, this only relates to insurances that you start from 1st April 2023 onwards. This will not apply to insurances that are already in operation as we speak before 1st April 2023. So if you already have a policy on which you're paying these premiums, that will continue to be tax-free. This is not retrospective, this is only prospective. So to that extent, there's a saving grace in this, but those who have been looking at this as a great tax shelter have now to look elsewhere and have to find other ways. The third provision, the tax on STT, Securities Transaction Tax, relating to futures and options contracts, have been increased. It may appear to be a very marginal increase because these security transaction taxes are always a very small number, 0.017% and thereof, going now up to 0.025% thereof. So it's a very small change, but believe you me, because these are applied on every contract, the overall cumulative sum is a big number. So we believe that this is again something that will have a bearing on the size and volume of contracts. At least in the short term, we are going to see a small contraction on futures and options contract going forward. This increases the cost of futures and options contracts. So it's going to be a bit negative, especially for people who kind of hedge their actual portfolios. Cost of investing goes up marginally. It's a little negative from that perspective, but obviously there's an easy way for the government to collect taxes, so that's what they've gone with as well. The fourth and the last one that I'm going to talk to you about is in respect of credit card payments. In the Finance Bill 2023, all foreign remittances, the tax collected at source has gone up from 5% to 20%, a 15% increase, almost 300% increase in the taxation. With the latest being is that the government has also included payments for credit card expenses incurred in foreign currency on foreign travel has also been brought under the Liberalized Remittance Scheme, or LRS as it is commonly called. By including it as part of LRS scheme, the government is also hoping that whatever you incur on your credit card bills will also be subject to the 20% tax. Now that's a big negative. There are lots of us who travel abroad, who incur credit card expenses because we have to use credit cards when we travel abroad. Now, all those remittances will also additionally suffer a 20% tax on that. We need to be conscious of how much we are spending when we are on an overseas trip, because on the credit card amount incurred in foreign currency, you will again pay a 20% tax collection charges. So these are the four big finance provisions that investors need to remember that comes into play after the 1st of April 2023.